Hello, Ted Oakley here in Austin, Texas with Oxbow, and today it's my pleasure in the first of the series that we're going to be interviewing Danielle DiMartino Booth, who is what I consider to be the best Fed person in the U.S. I've read her work since she's been in business. And just a little bit about her. She started on Wall Street, so she knows that game. Credit Suisse, DLJ, for all those that remember Donaldson Lufkin. And she went on to be at the Dallas Fed for 9 years with Richard Fisher, well-known people. And then she started her own company, she is CEO and chief strategist for Quill Intelligence. And she will give you a little more info on that later on in the interview. But Danielle, welcome.
It's great to be here, Ted.
I want you to do most of the talking, but I will have a few questions along. But I know you have, there's some comments to cover, and basically how the Fed got in the mess they're in today, and then the debt levels, what that's done to companies and individuals, what it's done for world trade, and then maybe lastly looking at buybacks, a real sore subject for me, and also what we're seeing with the election coming up. So I would start out and just say, how did we get in this mess?
So on October the 19th, that's kind of where this party started. 1987, Alan Greenspan was aboard a flight from Washington, D.C. to Dallas, Texas. He had been chairman of the Fed for all of 2 months at that point. He'd come on in August of 1987. And when he landed, a Dallas Fed staffer rushed him at the airport, handed him one of those brick phones that Michael Douglas had on the beach in Wall Street. Chairman Greenspan, we've had a 23.4% loss in the stock market, the largest in U.S. history. Everything has crashed. You know, the world is ending. So suffice it to say, Greenspan did not make it to the podium on October the 20th, 1987. He was aboard another flight back to Washington, D.C., and that day he released a statement that basically said the Federal Reserve, in its capacity as the nation's central bank, is here to backstop the banking and financial system. So it was banking and financial system in that statement. And what was critical was what followed. Greenspan was obsessed with the stock market. He had a daily briefing on his desk, which was very unusual. Volcker, his predecessor, could have cared less. I mean, he made a point of, not caring about Wall Street. He was the opposite. He had a real obsession with it. In the weeks and months that followed October the 20th, 1987, he sanctioned the Federal Reserve's New York desk, the open market trading desk, leaking informations to bond trading desks prior to Fed injections of liquidity into the system. So any of you in the business know that's called front running. So that was the day that the Fed put was born, if you will. That was when Wall Street started to learn how to game the Fed. So in the years that followed, whether it was the tequila crisis in Mexico in 1984 or the municipal bond crisis out on the West Coast, long-term capital management in 1998, when it looked like Treasury systemic risk might become unglued, 2000, 2001, every single time Greenspan initially stepped in and put a floor under asset prices. And with this, we had the birth of the put. We, as investors, came accustomed to working based on moral hazard. You can take risks, but you're not going to have to suffer consequences. And that blew up in a big way in 2000. Greenspan rolled in with lower for longer. We had the housing bubble that blew up. That brought on the great financial crisis. Systemic risk showed up in a different way than it did with long-term capital management. It manifested in German Landesbanks. We found out that international investors all the world round held subprime mortgages on their balance sheets. That was the ignition of this of the systemic risk with the breaking of the buck of a money market fund. Roll through quantitative easing, blowing up the balance sheet, and everything that happened since then, the Fed has had to throw more and more and more debt out into the system in order to stave off investor losses. This culminated, of course, with the debt levels that we got to prior to COVID-19. We have to understand that Fed liquidity in 2019 was the highest since 1969. Again, this is prior to COVID-19. We were left with over $10 trillion February the 21st, 2 days after the stock market peaked in 2020. The U.S. bond market crossed the $10 trillion line. Overall non-financial debt was almost $16 trillion, 74% of GDP, whereas it was subprime mortgages going into the great financial crisis. This time it's been a crisis born of corporate debt. That's what brings us to where we are today.
Danielle, let me ask you too, back in January 18, did you believe Powell when he said we could go back to normalized rates, or do you think he was just trying to make people feel better?
So the Driscoll Hotel football season 2015, I had left the Fed, Richard Fisher had left the Fed, and we ran into each other at a UT-TCU game in Austin, and Richard said, I want you to pay attention to one person, only one person who's still remaining on that board. That's Jay Powell. I said, I can't pay attention to him. He doesn't say anything. He's a very silent person. He's very stoic. And he said, trust me, he's the only person who's focused on shrinking the balance sheet and on normalizing interest rates. Richard, my former boss, was there with Jay the whole time he was on the Fed board. In October 2012, Jay Powell said the following, which is recorded in an FOMC transcript: the Federal Reserve, with quantitative easing, is blowing a duration bubble across the entire credit spectrum that's going to be impossible to extricate ourselves from in the event we try and normalize interest rates. When he came on in early 2018, the Dow Jones Industrials had a quadruple, they had over 1,000-point loss that day. It was the biggest loss in years. Jay Powell said nothing. In his first congressional testimony, he said it is not the Fed duties to backstop the stock market. And he tried really hard to push through quantitative tightening, to shrink the balance sheet, to normalize interest rates. And in the beginning of his tenure as Fed chair, he sincerely believed he could accomplish these feats. But as we look back on Halloween of his first year in office, General Electric debt was downgraded. It traded the next day as if it was junk. By November the 14th, 2018, we had junk bond issuance in the country shut down completely. It stayed that way for 41 record days of no issuance. And that is what triggered the initial Powell pivot, when a man who was of a mind to set monetary policy back on a normal path found out that the bubble in credit was so big that he had to back off.
Have you ever seen anybody go from such extremes, though, from one to the other? It's amazing, to me anyway, to see what he's done. It
was pretty incredible, because his reported net worth when he became chair of the Fed was somewhere between $50 and $100 million. He was by far the wealthiest Fed chair to ever take office, and he was clearly there just to do his patriotic duty. And I think he intended on normalizing monetary policy, and now we have somebody in his place who's, completely. It's like Sybil. He's got a separate personality now, because he's more dovish than Mario Draghi, Janet Yellen, Ben Bernanke, Alan Greens. He's done more than they've ever done to destroy price discovery, which was his goal in the first place, was to bring us back to normal. He found out that the beast was too big.
Let me ask you this. You've got a couple of slides on debt and how that's really affected us. You might give us your thoughts on that.
So each time the Fed has had to come in with lower for longer, they've had to put more debt onto the nation's balance sheet. They've had to grow their balance sheet larger. It became a fad internationally, where the Bank of England, the Bank of Japan, the European Central Bank, even the People's Bank of China, every time we've had a financial disaster born of over-indebtedness, it has to be resolved with more debt, which is perverse, but it is what it is. Going into the second quarter of this year, we have $325 trillion of debt worldwide. These are unfathomable numbers. Morgan Stanley ran some interesting numbers at the very end of 2019 that again broke out where today's crisis is housed, which is corporate debt. And they found that reminiscent of what happened with credit rating agencies going into the subprime mortgage crisis, that when they overrated mortgage debt, the credit rating agencies had overrated corporate debt today. So it went from overrating mortgages to overrating corporate debt, such that Morgan Stanley determined that 42% of investment grade bonds in America in December 2019 should have been rated junk.
And the thing I wanted to mention on this slide that you have with that, first of all, it's hard to fathom 325 trillion, but if they'll notice the bylines on that and see how the big increase came in this past year, it's really mind-boggling.
And what's even harder to fathom is that through May of 2020, we've put on as much debt into the U.S. corporate debt system as we've put on in prior years. That's what Powell has done since then, because again, you had a $10 trillion or so. I've got a great pie chart that you can put up as well. But out of an over $10 trillion bond market, only about $2.5 trillion of that was rated investment grade. The rest of it, whether it was middle market debt, which has become a darling with private equity, with family offices, with pensions, middle market debt was pushing $1 trillion. You had leveraged loans, the bulk of which went into collateralized loan obligations. That was another darling asset class, and high yield debt itself, and then the BBB rated investment grade debt, much of which we've seen downgraded to junk. It all added up to something that was multiples of what we would consider to be true investment grade debt that we would put our mother's IRA into. And that is the problem, the challenge that Jay Powell has faced in his tenure, is trying to figure out how to contain the volatility in this very, very dodgy space in the credit market.
So let me ask you, and I've been told this, that there are something like 400 PhD economists at the Federal Reserve Board of Governors, not counting what you have in the 12 banks, regions. Would you think that they might not know that it's impossible to create the ability to not make anybody go insolvent, but it seems that they think that way? What do you think about that?
So I actually took a survey on Twitter, and 79% of people like you and me on planet Earth said no, the Fed cannot resolve an insolvency issue with liquidity. 21% said that they could. I think that was the 21% who are PhDs, maybe. Because if you add up everybody in the system, you get to almost 800 PhDs. And that does not include outside advisors. If you put outside advisors to the Fed, you get to over 1,000 PhDs. And most of them, there are some exceptions. Gary Schilling comes to mind. Bob Schiller comes to mind. There are some exceptions, but most of them have been schooled in the same thoughts. And they're predominantly Keynesians in the way they think. And they truly believe that models can resolve anything and everything, including insolvency. And it's practically become a hashtag on Twitter. You can't print cash flow. And that's what I think the Fed does not understand. You can't print jobs and you can't print cash flow. But that doesn't fit into their model, so they disregard it.
So what do you think happens to the Fed when they notice? So somewhere in the next 12 months, a lot of downgrades have to come on these bonds. I mean, they're not going to be able to pay the interest on it. So what do you think happens with the Fed? What are they going to do in that circumstance? Because if you can't pay the interest, you can't pay the interest.
Well, and that's the case. And what the Fed is doing right now, if you think of Clear Channel, which is now with us in a different name, I think it's iHeartMedia, and Caesars, which is with us in a different name, TXU Energy, we carried along all of the dead weight from the last cycle into the current cycle by keeping the junk bond market open. But we never had a recession as severe as the one that we have today, which is going to become a cash flow issue, as you say. I'm providing everybody who's with us today with an outlook, and if you look at the sheer magnitude of expected defaults and expected downgrades to junk, fallen angels we call them, we've never seen anything like this in history. And the Fed has made a deal with the devil by forming special purpose vehicles to put on the Treasury's balance sheet, kind of Enron-like accounting, if you will, off-balance sheet accounting, in order to buy all the way down to junk ETFs, not just investment-grade ETFs. But they're still confined to certain strictures that preclude them from taking on really bad credits, which means that there is an inevitability to what's going to happen in terms of defaults and downgrades in not just the corporate bond space, but also the commercial real estate space. So they're both going to be happening at the same time, and there's a lot of refinancing needs in 2020 and in 2021 in both of these massive markets.
Let me ask you this. You've written before, and I totally agree with you on this, and you might explain this to the audience about why the Fed is to be responsible for this huge gap in the difference in incomes in the United States and how that's affected people. I know we're going to talk a little bit about buybacks, but you have some good comments on that.
So in the 70s and 80s, we had the rise of unions in America, not just in the industrial space, if you were to think of the United Auto Workers, but also in the educational space. So the rise of teachers' unions. And that began to bring about inequality in the country, which we had not seen really in huge numbers since the late 1920s. So you add on to this educational divide between those who live in the right neighborhood and those who don't, those who can attend private school or live in the best zip code, and those who are in the public schools who are run by effectively corrupt teachers' unions. So the inequality divide started to widen out in the 70s and 80s. And then you have Alan Greenspan come in 1987 with the Fed put that effectively puts a floor under investor losses, and you start to widen this inequality gap because you're giving the top 10%. And then eventually, after the crisis, you're giving the top 1% the benefits of monetary policy being too loose, such that the rich get richer. It's a cliche, but it's happened, and the poor get poorer. They don't have access to the stock market. They don't have savings. They were slaughtered in the subprime mortgage crisis. They lost their houses then. They were told to buy more car than they could afford in the current cycle. So there'll be repossessions on that end. Going into this COVID crisis, we saw subprime auto delinquencies at recessionary highs prior again to this crisis. So the Fed creates an environment where the poor can access debt that they really don't qualify to access. They lose that, they become poorer, and where the wealthy are backstopped by Fed policy. And you've had the Fed come in, you've had monetary policy become a source of societal disruption in this country. And we haven't even seen what's going to come to pass with public pensions, which will make that even worse.
You know, you're talking about that, but if you look at spending, they do the same things over and over again. You know, more borrowing, more loose money, more spending. And what did they come back with the next time around? The same thing that got them there in the first place. I find that interesting in its own. But the other side of this equation is right now in the country, it seems to us that we're operating two economies. We have the one that's been picked up by all the financial assets going back up, so everybody feels good. And they're like, you know, it looks like we're coming back, looks like we're coming back. And then I'm on the street, and since I grew up this way, I can talk to these people. And I ask people, hey, what's going on with you? How's it going? They're in a real state right now. And so we have two Americas right now, don't you think?
We have never had this kind of bifurcation in America. And if you will, right today, what's happening does not have to do with the haves and the have-nots. It has to do with those in the middle. A University of Chicago paper that's making the rounds, and it's all over the media, has found that 68% of the individuals collecting unemployment insurance today are making more than they were prior to the corona crisis. So they literally have more in take-home pay than they had before, because the CARES Act provides an additional $600 per week for everybody collecting unemployment insurance. It may not sound like a great deal of money, but if you're a waitress, if you're somebody who works in a hair salon, you're making more money than you made before And if you're wealthy, you're wealthier than you've ever been because the Fed backstopped all of, the publicly traded companies and the stock markets come back. It is the small business owners. It is those in the middle class. It's people who've made $75,000, $100,000, $150,000 before this, who didn't qualify for any kind of government handout, who are closing their businesses, who are true entrepreneurs, and who feel like come November, they don't have anybody to vote for. They didn't want to sanction socialism, which we have in the bottom tier of income earners. They didn't want to make the wealthy wealthier because they've worked hard their entire lives to start these businesses that were solvent but illiquid, but couldn't get bridge financing. So what we're seeing today is unique. It's not just an inequality divide, but we're seeing a slaughtering of what's left of the middle class in America, and it's a true tragedy.
It is because, I don't know if people don't know anything about history, but if you look back historically, when you blow up your middle class, it usually blows up your country, or it goes into some sort of state of stagnant, stagnant forever or something, because you have no middle class. I don't know if they don't read about it. It's unusual to me, and all these people that should know something don't seem to know that.
Well, it's I don't even have to be remotely political to say that Steve Mnuchin is likely the most corrupt Treasury Secretary in U.S. history. And again, this is not a political statement, but he comes out on TV and says that the Paycheck Protection Program is about protecting people on the payroll. The small businesses stopped taking paycheck protection loans because they had overhead and were restricted in terms of the capacity with which they could reopen their businesses. They never even fulfilled the entire loan capacity that was being sent out to small businesses and to deaf ears with Mnuchin, because Mnuchin is getting most of Trump's base covered with unemployment insurance, and he's getting his buddies in hedge funds and on Wall Street and in private equity. He's got them covered too. So again, it is political and it's not political to say that if you hollow out the middle class, this is when you have the potential for things that we don't even think about called revolutions. When the middle class rises up and says, we don't have representation, and yet we're being taxed to kingdom come, and we were not given the bridge financing that we deserved as solvent companies. We're in an extraordinary chapter in American history, something that doesn't happen but every 40, 50 years is what we're seeing today again, because it's the middle class that's in the crosshairs.
And at Oxbow, we've been looking at this in terms of an inflationary impact, because you've drained the average worker so badly in the last 15 or 20 years that they're to the point to where they're probably somewhere along the way going to rise up and say, look, you have to pay me more money. Okay, we're not going to just sit here and let you run us for the next 10 years. And I'm noticing that. And on that note, one of the things I think that's come out of this bed that's made it so tough on for public companies' employees is they've made it such that they've given us so much money, they've been able to go in, take debt, buy back stock, and I don't know exactly the number, Danielle, but I think it's somewhere in the 300 category as far as what they get paid at the top relative to the lower employees. And to me, that's a real problem right now. You've got a slide on that in here.
I do. My good friend Christopher Cole, who's at Artemis Capital there in Austin, has done some extraordinary work on what earnings per share would be absent the effect of share buybacks in the past cycle, call it over the past 11 years or so. And, and the quandary, if you're Joe Q, chief financial officer, chief executive officer, is that you are to maximize shareholder value. So whether you're American Airlines, United, you come in and blow through 96% of your cash flow over the past 5 years in share buybacks. If you're ExxonMobil, which lost its pristine credit rating, why did S&P and Moody's take it down last year? Because they over-levered in order to buy back their shares. So this share buyback crisis not only further widened the inequality divide, but it stripped many companies of the cash flow that they desperately need today. And it trained executives to effectively insider trade their own stocks. They've done leveraged buyouts of their companies to the effect of 50% of earnings per share since 2009 have been fabricated via debt-financed share buybacks, which hit $1 trillion in 2019. And it has only angered the working class that much more because now they're aware of things. They have social media. You could hide it way back when the law changed in 1982. You can't hide share buybacks anymore. You can't hide the fact that the CEO is running off to his villa in Aspen or wherever he is, and that he has been fleecing the working classes. That is why we had Bernie Sanders. That is why we have Donald Trump. It is because of this that you have a population who feels like they have to vote radically because nobody can hear them because of what the C-suite occupants have been able to do in their minds to them.
5 years later, they bring in his or her buddy, the next person up, and they do the same thing over again. That's what's incredible. And we have no boards of directors really that are independent to say, hey, let's pay down debt. Let's give money back to the shareholders. We give them a dividend. We can pay down debt. We can clean this thing up. And they're just as bad as the Fed, in my opinion, as far as making that happen. So let me ask you, along that same line, what do you think is going to happen to buybacks nowadays? It's really getting a black eye now. Hopefully it'll get a big black eye, but what do you think is going to happen in the next 1, 2, 3 years with that?
I think it's going to depend on how the congressional election outcome goes here in November. And I've heard some really smart people say that it could go to the midterm elections in 2022. That could be when there's enough time that's passed. There's really not enough time to pass right now to drain the swamp, which has gotten swampier, let's face it, in the past 3 years. But I do think that there might be more Elizabeth Warrens in the future who put share buybacks under a greater level of scrutiny. Again, even if you take the share buyback, even if you take the shareholder return aspect away from the equation, it's legally sanctioning insider trading. There's no two ways about it. And it would be easy enough to take it to the Supreme Court if it didn't work in Congress and say, this is just flat out illegal. So we'll have to see what happens. I do think that because of the expected duration of this downturn that we're in right now, that everybody thinks is going to be a V-shaped recovery. You don't have V-shaped recoveries if you hollow out your middle class. So I do think that there will be enough economic hardship in the coming years to keep share buybacks as a subject, as a need for reform on the front burner. And I'll use my soapbox to make sure it stays that way as well.
So let me ask you, and I'm saying this to the investors on the call, we have some professionals as well, but on the investor side, just so you know, understand price discovery, when you're in the money management business, you're trying to find things that still have some value to them that people probably haven't recognized. And so when we look out on the landscape over the next 2 or 3 years, particularly, and you look at that and you look at something and you say, you know, how am I going to make money? That's a tough question when you look at where interest rates are, markets really inflated past the point of where they should be because it's superficial, and what you've got going in the world. What do you think about all that?
I think that the onus is on investors right now to do more homework than they've ever done. Because of the advent and the domination of passive investing, and because of the duration I believe we're going to have of the coming downturn, I think it's all going to come down to balance sheets. Balance sheet, balance sheet, balance sheet. If they pay a dividend today, can you foresee them paying a dividend in 2 years? What is their business model? How recession-proof is their business model? Are they going to be able to take out weaker competitors? Are they going to survive the default rate cycle? Look at who's going to be taken out of a given industry and look and see after that who's going to survive. And then look at their balance sheet. We're going to have to go back to doing some real get your fingers dirty, get your fingers in the mud, true due diligence balance sheet homework to find, and whether you're talking about, again, real estate, or because the leverage is everywhere, it's going to come down, at least in my mind, truly to balance sheets, whether you're talking about a sovereign nation or a corporation or a real estate investment.
You better, I know what we've done a lot of the last couple of years is really upgraded quality. We made sure that you're in the top tier of whatever you own. And I know in the companies we own, the stock side, low debt is a major part of what we look at, and we want to have earnings, for example, that can make it, across the river here as we go forward. Let me ask you, I have two more things before we wrap up. I had a couple questions sent in, but two more things. One, there's a slide here on the election and unemployment during elections. What's your thought on that coming up?
So, if Donald Trump pulls off being reelected, it will be historically unprecedented in U.S. history. The consensus estimate for the unemployment rate on election day is 10.3%. And in fact, I've got a brand new slide in the weekly that I sent yesterday that you can put that up. That is a 377% swing from October of 2019. If, as consensus is expecting, we see the unemployment rate come down to 10.3%. 10% is the ceiling unemployment rate in the post-war era. Investors, Americans, we've never known that level to come down to on election day. The misery index, which is something that we bring that we brought into that table, that equation that brings inflation into the picture. You've got food inflation up 4.1% year over year. If you combine the unemployment rate with the inflation rate, your misery index is at unprecedented levels, including when Jimmy Carter took office. So if Trump is to get reelected, it will be extraordinary in historical terms. And if the economy continues to degrade, as I think it will, and if the stock market takes a step back, which nobody believes can happen, I think that we truly tread into geopolitical waters that we haven't seen for generations, because there'll be a sense of desperation on his part to keep his base intact by attacking China. So we've got many different factors going into this election. And if the economy is not with him, then I think that we will have potentially some historical moves made by Donald Trump, pushed by Steve Bannon himself, who's still pretty much running the foreign show.
And it seems like, in just what you're saying, that everything you've just said is not discounted in the market right now.
Oh, heavens no. People need to understand that that again, long-term capital management, and I've written about this in what I published yesterday. Long-term capital management involved a relatively small, to this day's level, hedge fund that was going to ignite systemic risk in the Treasury market. What people forget about March, because it's like, well, for any women who are listening, it's like childbirth. We've all had to forget what March felt like in the financial markets. But for people who remember March, it wasn't the meltdown in the stock market. It was the fact that Treasuries quit trading. That was what prompted the Fed to action. You cannot have the world's risk-free asset hit a systemic risk bump and quit trading. And JP Morgan could not get a bid 3 times in one overnight session in Asia when I didn't sleep. And Treasuries quit trading. So we have to understand how extraordinary it was for the Fed to come in and say, we'll buy junk bonds. The European Central Bank, the bank, nobody had gone this far. And that's how afraid they were of what happened. So if you can't comprehend that we had a systemic risk moment and that prompted the re-upping in financial assets, it is an accident waiting to happen on many, many levels. The E in the price to earnings ratio is right now, it's undefined. 182 of the 500 companies in the S&P 500 have no earnings guidance. So you don't even know what the price to earnings ratio is. You're flying so blind. Dividends are being cut left and right. companies that you never thought would do layoffs are doing layoffs, and this is pushing its way up into higher income earners. Enjoy your investment right now in the S&P 500, but for God's sake, be hedged.
I agree with you totally. That's why we always people ask us why we have liquidity, and we say, well, since we don't know what the E is in the earnings, and nobody else does either, how could you make a statement that I know where we're headed in 4 or 5 months? And the last thing I'll ask you, there's a slide there on Wall Street and Main Street. Do you have any hope that these two can come together? I mean, they seem to be together in the 40s and 50s and 60s, but perhaps, not so much, and it just doesn't look like that's going to happen.
So you do something fundamental. I'm a broken record at this point, but there's a fundamental degradation of the economic infrastructure when you take small businesses down. Prior to the Corona crisis, they employed 47% of Americans, and you've now basically shown the bottom tier of income earners what universal basic income feels like, because they're refusing to come back into the workforce. And you validate it for the wealthiest that they're going to have their backs covered with Fed policy. Because you're going to widen the income gap and sweep in the middle class, I cannot see a coming together, because it will require a ton of innovation and entrepreneurship in this country that you've basically taken away for a generation. Again, I think that this is going to be a political solution eventually, a third-party type of solution that helps us find our way back to having integrity in terms of the social contract with our people. We don't want to put people on the dole, and we don't want to make sure that the wealthy stay wealthy. We need to make sure that it comes up from the middle, and I can't see that divide closing anytime soon, Ted.
Maybe that's the Neil Howe Fourth Turning book comes to place there. You know, I did thank you very much. We had a few questions, just a few that came in. I wanted to ask you, and one question. This was questioned 2 or 3 ways for us, but I'll just give you a synopsis of this question: is when do you think that that Congress and its inability to come together to pass any sort of fiscal policy, what period did they basically just say, hey, we're going to delegate this to the Fed and they can take care of the economy and we're going to shirk the responsibility? How long do you think that's been going on?
So I think it became, it was a feel-good factor when Greenspan was in office. And they knew that even in very good, robust economic times, that Alan Greenspan would make sure that they stayed really good and comfortable. But it was the aftermath of the financial crisis when Congress basically closed for business and put everything on Ben Bernanke and the Fed. And when there was a moment in time that we could have stepped back and not done QE2 and then not done QE3. And, you know, when we had the bond market meltdown because Bernanke said he might start to shrink the balance sheet. It was the QE2, QE3 moments, I think, that's when Congress abdicated its authority to the Federal Reserve.
Thank you. The other question we had to do with private equity. And this question came in and said, look, if you look at private equity showing actually plus returns in the first quarter, and this is, you know, they pull it out of thin air, and their point was on this question, so what happens when this is an asset class, so to speak, that sets their own prices? Nobody's sold any companies yet, by the way, so they don't know what they can get. And yet, they still hold themselves out as a great asset class, and we have no idea what the returns are going to be. What would you think about that?
I think that there are a few rogue public pension fund managers who have said the emperor is butt naked, and they've stepped back from the asset class as a whole. Private equity spent $3 billion in the first quarter lobbying Congress to have one of the Fed's facilities open to their portfolio companies. And the Fed then changed the language of its Main Street lending program to allow EBITDA that is basically cooked. That's how private equity functions. They function based on EBITDA of their own creation. And the Fed relaxed its lending policies for its Main Street lending policy such that companies with up to $5 billion in revenue and 15,000 employees with shaky balance sheets, even if they were pass-through entities just to cover taxes, it is a large entity that has been set up to bail out private equity so that they can continue to pay themselves through this crisis and not have to realize the garbage that they have set up. But if you look at the likes of Hertz, if you look at the likes of Neiman Marcus, you know that there is a point of liquidation in the future because they can only prop these companies up for so long that they can. And trust me, Neiman Marcus and Hertz they're both products of private equity. So you can't play this game forever because at some point the defaults are going to come and get you, and they cannot make these portfolio companies generate cash flow if their business models fail. They can pay themselves a little bit more for a little bit longer, but trust me when I say it's the GPs, not the LPs, who win in the end.
The last question, and we'll finish up here, but came in from a professional that said they looked at the 50 state retirement plans, and the average actuarial return was 7.4%. And they also looked at the last 20 years from Dalbar on the S&P, which was 6.1%, full S&P 500. And the question to you is, what are they smoking that makes them think that they can get this 7.4%?
Well, what they're doing is compensating for cash that they cannot demand of the cities, states, municipalities. If they lower their rate of return assumption to something realistic, that means that mathematically they have to demand more cash from the state or the municipality. The actuary for CalPERS a few years ago, this is 2012, the actuary for CalPERS stepped down from his position because he said, we don't need to go from 7.5% to 7%, to 7.25%. We need to go all the way to 7%. The California state legislature said, we can't, that'll bankrupt the state. And he quit in protest because they couldn't take it down to where it needed to be. The short answer is Illinois is the very first state to have approached the Fed for its emergency municipal facility because it's got the highest percentage of alternatives, private equities, the lowest amount of cash flow. It's the most underfunded. Maybe New Jersey's in the running as well, but it's with good reason that the Fed is also being asked to bail out states, and that's because these public pensions are never in a million years going to hit their bogeys.
I want to personally thank you. You know, I think your service is fantastic, and I wanted you to share with everybody on the call because I think there's a number of people that would like to take your service, and you might give them some info on that and your anniversary piece and everything at this point in time.
So for the past 5 years since I left the Fed, I have every Wednesday faithfully published a weekly. It is now called the Weekly Quill. 2 years ago, I founded another company, rolled that into it, and we published something called the Daily Feather. So every trading day of the year, we publish a daily. We've recently rolled out something called the Quick Quill in the morning. It hits your inbox before anything else, where we provide you with investable, actionable ideas. So you get that every day along with the daily. And then we provide a deep dive weekly that it combines history and analysis and looks whether it's going to be into commercial real estate or private equity or public pensions or the stock market and a lot of credit as well. But we publish that every Wednesday as well. We've just put out a seminal piece, our most comprehensive ever, on what the reopening economic outlook is going to be. Ted's going to share that with all of you in PDF form. And to celebrate our anniversary right now, we're actually running a 25% off promotion, which makes me sound like a used car salesman, but it's a great time to become part of the Quill Intelligence research subscriber community.
And I would say this in signing off that the last time I saw Danielle, I told her this in person, but I really believe she's one of the best writers that I've taken research for 40 years, and so I know what I'm talking about. She writes it straight. She gives you some of the best information you'll ever see. And so Danielle, thanks again and all the best. Thanks for being with us so much. Thank you very much.
Absolutely. Let's do this next year in Austin, Texas.
Okay, will do. Thanks.